So putting this video together is going to be a lot of work, but I'm going to go ahead and create everything that you need to know about fundamental analysis. We're going to take it step by step. We're going to demystify the whole process because it can be quite confusing. Fundamental analysis, when you open up the spreadsheets, when you open up the balance sheets, cash flow statements, when you look at the valuation measures, it can all be overwhelming. It can put the mental and fundamental analysis. But what I'm trying to do is put a little bit of fun in fundamental analysis, because I promise you, once you're able to figure out exactly what these complicated, intimidating metrics mean, it's going to change the world for you when you go ahead and evaluate certain stocks. You're going to be able to find the intrinsic value of certain companies. You're going to be able to see if a stock is overvalued or undervalued. And if it's undervalued, you may want to go ahead, do further research, maybe add it to your portfolio or keep holding on to it in your portfolio. If you see that a stock is overvalued, that might be a good time to lock in profits if you're already holding the stock, or stay away from the stock, keep it on your watch list, but don't buy in when it's overvalued. And so with that being said, we're going to jump in to part one of everything that you need to know about fundamental analysis. Okay, so the goal here is that if you're on Yahoo Finance and you want to take a look at the fundamental metrics of any company, so let's say Intel, for example, we're going to go here to statistics. And what we're going to be covering in this long video that's going to teach you a lot, I promise, is that we are going to cover every single one of these valuation measures, so that when you go ahead and you click on statistics, this is the first thing you'll see is these valuation measures here. You're going to be able to understand each and every one of them, all the implications, limitations, what they mean, and it's going to make you much better at analyzing stocks. And so I'm going to start with these right here. This will be the game plan. So we're going to cover all of these because they're easier to understand. They have price involved. And then towards the end of the video, I will cover market cap versus enterprise value, and then show you what these enterprise value ratios are, which is enterprise value over revenue and enterprise value over EBITDA. And we're going to cover exactly what that is. And I'm telling you, just suffer through this video, watch it a few times, and then you'll be so much better at understanding articles that you read, at understanding when different analysts talk about stocks. This is going to help you out majorly. So let's get started. And we are going to start with trailing PE and forward PE. All right, so right off the bat, I want to talk about a common misconception of the PE ratio, which is the most popular metric for valuing how cheap or expensive a stock price is relative to its competitors. That being said, PE, commonly people refer to as price over earnings, but it's actually the share price over earnings per share. So it's EPS, it's not earnings, it's earnings per share. So simply and mathematically, it is the current price per share divided by the earnings per share. So the question then becomes, how do we calculate earnings per share? And people often think maybe it's last quarter, maybe it's the last 2 quarters. If nothing else is specified, when you see PE ratio, so for instance, if we go to Intel here and we take a look at their PE, we'll see that it's 9.61. And since there's no other qualifiers to let us know what type of PE, when you see PE, it is typically calculated by dividing a company's stock price by its earnings per share from the most recent fiscal year. When people refer to the PE ratio, typically they're referring to trailing PE because it is calculated by dividing the current price by the earnings per share over the past 12 months. And as we can take a look here, Intel's PE is 9.61. Advanced Micro Devices, which is its competitor, is 48.11. And so when using PE, you want to be comparing it to another company in the same sector. Because as you'll see here, if we take a look at Tesla's PE, it's 368.97. Doesn't really help us when comparing with Intel and AMD because they have different business models. They have different types of revenue streams. And so we have to be careful about comparing apples to apples, not apples to oranges. So we can use PE to compare Ford stock to GM stock or Intel stock to AMD stock. When using PE ratio, stick to the same sector to make sure PE analysis is most effective. So as we see here for Intel, the PE ratio is 9.61, and for AMD, it is 48.11. So you might think, wow, AMD is way overpriced. However, there can be a reason for it. A very high PE ratio could mean that the underlying company is overvalued at the moment, but it can also mean that investors are expecting rapid high growth rates in the future, which would bring the PE value down with time. So for instance, AMD, its chips are amazing. Intel has had some major delays, and its recent chips are not competitive to AMD's top of the line chips. So people are okay at purchasing AMD at around $155 today with a PE ratio of 48.11 because they're so confident that over time, AMD is actually going to continue increasing their earnings per share. So basically, PE answers the question of how much money investors are willing to pay today for a certain stock relative to the earnings per share. So when you're researching a stock, you will typically see, if you're just using a simple dashboard, you'll see some general information like the year range price, the market cap, the volume, but you'll also see PE ratio. And for a lot of stocks, they simply have a dash or null. There's nothing showing up for PE ratio. Why? Well, if there is no PE ratio for a company, it simply means that the company is not profitable, and so it has zero earnings. And since zero cannot exist in the denominator, because remember, share price over earnings per share is how you calculate it, since this part cannot be zero, the price to earnings per share is undefined or not listed. And that's all this means. The company is not yet profitable. As we can see here with Tesla, although the PE ratio is a very helpful metric when analyzing a stock, it does not paint the big picture and should be used with other metrics, analysis, research, etc. when making investment decisions. Because if we go ahead and we look at Tesla, PE ratio of 368.97, and the PE ratio of Ford, which has a PE ratio of 27.51, even though Ford is going to be competing with Tesla, they're putting a lot of their new line of cars as electric vehicles. They're betting big on themselves as an EV player in the coming years. That being said, Tesla's PE ratio makes absolutely no sense. It's 368, right? But you could possibly be using something like forward PE to get a better metric for Tesla, and I'm going to cover that in a separate video. But why do people buy low PE value stocks? For instance, Ford was just recently under 10 PE ratio. Why is that? Typically, it's because investors see them as undervalued and believe that the future projections for growth are being undervalued. However, there are times that investors buy high PE stocks because they feel the company will actually outpace the predicted growth and the PE will look more appealing down the line. When a stock is growing at a very high clip as far as revenue, earnings, expansion, etc., investors typically tolerate a higher PE ratio. And we could see this with Tesla. People are tolerating a 368.97 PE ratio, and I believe this PE ratio was above 750 just very recently. And the reason it went down is because Tesla reported great earnings, which factored into their earnings per share, which means that their denominator became larger, and that means that the PE is going to be smaller. Now with Ford, in the past year, it has actually worked out to buy them at a low PE, because now better news is coming out about Ford. There's a lot of projections that Ford will be doing well, and so people ran up the stock to a price where the PE ratio is now 27.51 instead of hovering around 10. That being said, you can't just go by PE ratio. That will be something called a value trap. And a value trap occurs when folks buy companies with a low PE ratio because they assume it's a good bargain, whereas the reason for the low multiple is actually that they are experiencing financial instability and they have little future growth potential. For instance, BlackBerry used to be very profitable, and then they ran into a lot of trouble. And at some point, they were trading at a great PE ratio, very, very low. However, we all know how that worked out for them. Now, something else I want to mention is that when there's a market correction, so when investors go and they take money out of certain sectors because the market is crashing, because of fear, uncertainty, doubt, whatever it may be, when there's a broader market sell-off, usually the stocks that have a lower PE ratio, so for instance, Intel And the AMD, which has a higher one, Intel has a lower PE ratio. Typically the stocks with the lower PE ratio, they're the ones that get hurt the least. So not a lot of capital outflow from the low PE ratio stocks because they're kind of trading on basement floor prices anyways. Whereas AMD, it is trading at a lofty PE of 48.11. And so it tends to drop more percentage-wise than something like Intel when there's a broader market sell-off. At least that's what I've found in my findings. If you disagree, please mention in the comments. So again, looking here at the valuation measures on Yahoo Finance for Intel, we can go ahead and see that its trailing PE is 9.82. Again, trailing means that it's the past year. So they are taking the past year of earnings per share, and it's basically telling us what the market is willing to pay, what the current investor is willing to pay for Intel relative to its past earnings. And so you would want to compare this number against other numbers in the same industry if you're deciding between different stocks in the same sector. Now we're going to cover forward PE, where Intel sits at 13.97. Forward PE ratio, and that is basically the future price to earnings per share, and this metric uses future estimates, which is obviously not going to be as reliable as the typical PE, which is a trailing PE that's using the last year's earnings. And so it's really important to point out that when we talk about last year's earnings, we're not just talking about the past 12 months, it can also mean the fiscal year. And that doesn't always mean that it's the last 4 quarters, and it doesn't mean that it starts on January 1st and ends on December 31st. For example, the US federal government uses a fiscal year that starts on October 1st and ends September 30th. Now, some analysts, they will completely tarnish and destroy the reputation of forward PEs. They'll say they never pay attention to them, but I think it is important, especially when comparing the forward PE to the trailing PE, you can get some insights into your potential investment. Now remember, forecasts, they're always subjective and they can be highly unreliable. Like I said, analysts are usually all over the map, and even if this guidance is coming from the company itself, it doesn't mean that it's very accurate. There's a couple of things that companies are known to do. One of them is sandbagging, and that is when they go ahead and they give you kind of low ball estimate because they want to come out and then beat those estimates because that's when the stock tends to go higher. Now, conversely, a company tends to sometimes over exaggerate their earnings. And this is because maybe this quarter, they're going to be reporting bad earnings, but during the earnings call, they're going to over exaggerate the earnings that are going to come in. They're going to say, okay, I know we didn't do too well this quarter, but look, next quarter, we're expecting to do this, this, and that. And then they kind of try to quietly later adjust the expectations prior to releasing the earnings. Now, obviously that loses the trust of the investor, but a lot of people, they don't follow it too closely. And that's why it's really important when using a forward PE and trying to weigh like how much you're going to value it in your assessment process, you have to go and take a look at the history of a company and see if they do have a history of over exaggerating or sandbagging future earnings. Because if they do have a reputation for that, that's something to take into account and maybe not weigh the forward PE too much if it's coming from the actual guidance of a company. And I wouldn't recommend ever taking forward PE as gospel or putting too much faith into it, especially if it's coming from analysts that are always all over the board. If you take a look at what analysts are predicting for Tesla's stock price over the next year, it's ridiculous. It's such a wide range. I might as well ask my cat what the price is going to be. So you do have to take this into account. Always take forward PE with a grain of salt. So again, trailing PE is when you're looking at historical prices to calculate the price over earnings per share, and forward PE is when you're using forward metrics, future predictions of the earnings per share to calculate price over earnings per share ratio. And so you can see that the forward PE is bigger than the trailing PE, which is always a good sign. But you always want to compare these to a stock in the same sector, to a few stocks, to see how they measure up and is it really undervalued in relation to its peer stocks. And also, I want to point out, since it doesn't say anything about the amount of years, you would have to assume that trailing PE is just trailing 12 months, so the past year, and forward PE is the future year. So 1 year forward, 1 year trailing. If, however, it says something like 5-year expected, as we see here in PEG ratio, which we'll cover in just a second, this is when you should take it into account and realize this is not 1 year, this is 5 years. So what is a PEG ratio? Well, a PEG ratio can help you find growth at a great price. So how do you calculate PEG? Well, you basically take the PE ratio and you divide it by the growth rate of earnings. Now, this is the tricky part. In the Yahoo example that we're going to take a look at in a couple of minutes, you'll see that they use the 5-year forward earnings growth. And this is basically a forecast. However, many people, they use a trailing growth rate. And trailing, and remember TTM, that means trailing 12-month period. So you can use 1 year, 3 year, 5 year for earnings growth. Just remember that whatever you're comparing it against, that you have to be using the same exact timeline for it. So you take the PE ratio and you divide it by the growth rate, however you are attempting to calculate it. And what this does is the PEG ratio determines stock value while also taking into account the company's expected growth or historical growth. Again, that depends on if you're using forward growth rates or if you're using trailing growth rates. And remember, this gives you a bigger, clearer picture. A low PEG and a PE value that's low can indicate a stock that may be undervalued, and using other fundamental analysis, you might think to yourself that it may be a good investment. And you should always compare a PEG ratio of one investment to another in the same industry. So again, you want to be comparing apples to apples, not apples to pineapples. And always bear in mind, the two that you're comparing, were they calculated the same? Were they using a forward peg or a trailing peg? And the timeline, was it the same? Was it 12 months, 1 year, or 5 years? Now, the tricky thing with a peg, same as PE, you cannot have a company that's not profitable. Then you can't use the peg. But with a PEG, you also can't have a company that is having negative growth rates. So they're doing worse and worse with growth. A PEG rate wouldn't really apply here. And so PEG gives you insights into whether the company has a high enough growth rate to justify its PE. PE is a snapshot, whereas PEG ratio can give you a more dynamic picture. It adds an element for much more helpful analysis. So again, if you're evaluating a company based on fundamental analysis and it has a low PEG ratio and a low PE, that might actually prove to be worthy of doing more research, using other fundamental metrics, maybe even using technical analysis, doing as much DD as you can. And also remember, a PEG ratio does not take into account any dividend payouts that are occurring, which may skew the picture a little bit. So always be mindful of all these different factors when doing fundamental analysis. So now let's take a look at a real life example, and then we'll try to dissect what the implications are. Okay, so right here on Yahoo Finance, I pulled up Intel and AMD, which are direct competitors. They're both profitable companies, and they're both expected to have positive growth rates. And so in this case, it's actually very helpful to go ahead and compare PEG ratios. Where can we find PEG ratios? Well, as we covered before, you can scroll down here, go to statistics, and you will see certain fundamental analysis valuation measures. Now, keep in mind, you can only see the quarterlies, not the monthly or annual, because you need to pay for that. Everyone's trying to collect theirs, and Yahoo Finance is trying to collect it as well. So if we take a look here, the trailing PE for Intel is 10, and the forward PE, remember this is future prediction metric, is 14.29. If we go to AMD, we can see that their trailing PE is much higher, 42.49, and their forward PE is also in the 40s. So you might say to yourself, wow, Intel is extremely undervalued. However, the PEG ratio, which takes earnings per share growth into account, is showing a different picture. It's showing that Intel has a 2.86 PEG ratio, whereas AMD has a much lower PEG ratio of 1.22. And we can go further and we can actually calculate the forecasted 5-year earnings per share growth. Because we have the trailing PE, and because we have the PEG, and because the PEG ratio is calculated by PE divided by earnings per share growth rate, we can go ahead and take the PE value, divide that by PEG, and see what the 5-year forecasted growth rate is. So bear with me, this is an extra step just in case you're curious of how this is done. So for Intel, we could take 10.05, which is their trailing PE. We can divide it by the PEG ratio, so divided by 2.86, and you will see 3.5 here. And this is a whole number percent, so you don't have to move the decimal point over. You just see that the expected 5-year growth is 3.5% based on projections. I don't necessarily believe this. I think that Intel is working on controlling its supply chain. I think it's expanding. It's going to see a much bigger growth rate than 3.5%. But this is what is projected for 5-year earnings per share growth. So let's remember 3.5% for Intel. Now let's take a look at AMD. So we take the PE ratio, the trailing PE, which is 42.49, and we divide that by the PEG ratio, which is 1.22, and we will see that the growth rate for AMD is much, much rosier, 34.82%. This is rather large, and this is why people are okay purchasing AMD today at prices that have a very, very high PE. Now, when you go and compare whether Intel's a good investment or AMD is a good investment, you should always look into the other valuation metrics and decide for yourself. Me personally, I'm going to take PEG ratio with 5-year expected with a grain of salt and a raised eyebrow because it is a forward-looking metric, which means there's a lot of predictions going into it. And for 5-year predictions, that's quite a lot. As we saw with the pandemic, with the chip shortage, with the supply chain issue, cargo ships sitting off the coast, nobody ever thought this would be the case 2-3 years ago. And so you have to take it with a grain of salt because the world, finance, stocks, it's an ever-evolving beast, and future forward predictions are not always accurate. Okay, so now that we covered all the PE stuff, trailing PE, forward PE, PEG ratio, now let's cover some of the other metrics that you can use aside from PE, like price to sales. And we'll talk about when it's best to use them and how you can add it to your fundamental analysis. PE value, such an important metric when doing fundamental analysis. However, we saw that some companies, they don't have a PE. It just has a dash or it's not even listed. Why? Because they're not yet profitable. This is the case for a lot of the growth stocks, a lot of the stocks that you guys see on Reddit. Why is that? Because they are not yet profitable. A lot of companies, they start out with just growing their revenue. They have very, very high expenses, and it takes years for them to become profitable. And so this is important to keep in mind because you cannot use a PE metric on a company that's not profitable. So what do? You use something called price to sales ratio. It's usually P/S. And the way that's calculated is you take the market cap of a company and you divide that by total sales. What do I mean by sales? Well, it's usually revenue over the past 12 months if we're talking about trailing PS. Remember, just the same as PE, PS can be a trailing figure or a forward PS. Forward PS is basically with forecasts. So you're using revenue forecasts in order to calculate it, whereas regular PS or trailing PS, and we'll look at an example later where it says TTM, which means trailing 12 months. So you take that, and that's the figure that you use in order to calculate PS. Now, just like PE, the lower the number, the better. So in a simple sentence, what does price sales tell us? Well, it tells us how much an investor is willing to pay for every dollar a company brings in sales. And this is very, very crucial and important when valuing growth stocks. Now, obviously, this should be used with other metrics, not just PS alone. But the reason I personally really like it is because I'm always skeptical of accountants. PS is great because it's taking revenue into account, not profits. Remember, profits takes revenue and expenses into account, and there are ways to kind of, if not cook the books, simmer the books a little bit so that it looks a certain way. And so there's a plenty ways to manipulate earnings. However, revenue, sales, that's very, very difficult to manipulate. Revenue is revenue. It has to go on the books. Unless the accounting team is just complete crooks, they have to report it. Whereas earnings, remember, accountants, they abide by generally accepted accounting principles, which is funny, generally accepted. It leaves the room for finagling, for a little bit of mathematical jujitsu as far as how you want to portray the accounting books. And so it's important to take that into account. Now, however, there are some downsides to price over sales. First of all, it doesn't take debt into account. It doesn't tell you if a business will ever be profitable as well. Because remember, you can be bringing in colossal amounts of revenue, but if your expenses are growing and growing, that's really bad. It also doesn't tell you if you can pay off the debt. Maybe your liabilities are so high that you won't be able to pay off your debt and there can be a catastrophe coming up. And that's why you shouldn't just use one metric when trying to value a company. Remember, a company can be really, really focused on growing aggressively, bringing in tremendous amounts of revenue. But the question is, at what cost? And this is why expenses and debt, it's important to look at, whereas the PS ratio, it doesn't take that into account. So always make sure to use the PS in conjunction with other metrics. Now let's hop behind the screen. Price over sales, in parentheses TTM. This means trailing 12 months. Remember, we talked about there could be forward PS. This is just regular PS, which is trailing PS. And you can see that currently it is 2.61. And if you're curious what they mean by current, just hover over and they tell you it's as of the date, November 29th. So Intel is 2.61. Let's go take a look at our rival, AMD. And let's see what their price over sales ratio is. And if we take a look here, we can see that their price to sales ratio is 13.35, much, much higher than what Intel was. However, this is understandable because if you take a look, you can also see their PE is much higher than Intel is. And this can suggest that Intel is being valued really, really low. Now, why are people doing that? Well, because AMD, they feel it's got better chips. They're expanding like wildfire. Them and NVIDIA are going to be taken over. Me personally, I feel that Intel is a huge underdog. Now, just for giggles, let's take a look at AMC's price to sales ratio. Remember, AMC, it's not a profitable company right now. So if we go take a look at the statistics, you will see that there's nothing listed for trailing PE or forward PE. However, if we take a look at price to sales, you will see they have 9.39. Now, generally speaking, and this is important, when using price to sales, you always want to compare it in the same industry, apples to apples. You don't want to compare apples to oranges. And also, just a general rule, if it's under 1, if PS is under 1, that's an excellent price to sales ratio, just generally speaking. Anything below 3, maybe 1 to 3 is considered good. Below 1, it's considered excellent. And anything above 3, you should kind of watch out for and figure out why the PS ratio is trading at such a high multiple at that time.
All right, so now that we covered price to sales, that means we covered all of these right here. And now we are going to cover price to book. And then we'll jump into market cap, enterprise value, and all the different ratios that deal with enterprise value. So what exactly is price to book? PB ratio, price to book ratio. I know people don't really read books anymore, but PB ratio is a very, very important and useful metric when doing fundamental analysis on a potential investment. So let's talk about exactly what it is and how to calculate it, because I listen to a lot of the videos and they tell it incorrectly. So the P part of P divided by B is simply the current price of the shares on the market. Very easy to find. It's the price of the shares. The B portion is the total assets not including intangible assets. So it doesn't include things like patents or goodwill. So you take the tangible assets minus the liabilities of the business, and that is the book value divided by the total number of shares outstanding. That is the B portion. So P over B. I'm going to show you a free resource you can use to find the PB of any company. And I'll cover that a little bit later in the video. So what exactly does PB ratio tell us? Well, it tells us at what multiple the company is currently trading at relative to the net worth of the entire company. The question is it really the value? They talk about book value because if you take a look at what it is, total assets. So they're talking about all their machinery, cash on hand, cash is cash. That's legit. But when you talk about machinery, is it really worth what they're listing it as? Let's say a plant like GM that has a lot of specialized machinery in order to create certain parts of whatever they're producing. Can they really liquidate that? If the company went bankrupt, would they be able to sell it at the price that they're listing at? Because the way accounting works is you buy a very expensive machine and then every year there's depreciation costs on it because it goes down value year over year because it's being used, it's getting older. But would you really be able to sell it at that price? It's similar to saying what the value of your home is with all the goods in it. However, if you had to go and liquidate your house and you had an estate sale, would people really be buying it at the value that you are saying everything costs in your home? Probably not. So always take PB ratio, the B portion, with a grain of salt. And when comparing PB, always do so in the same industry. You have to be wary of comparing it when doing tech or software type companies because again, those companies, they have a lot of patents, they have a lot of software. This is intangible assets and it's not counted when calculating PB. So what figures of PB are good? Well, a very low PB is good. Less than 2, generally speaking, it depends on the industry, is good. Less than 1 is great. It might mean that the company is way undervalued and people aren't appreciating how much it's actually worth, the foundations of it. However, a company that's trading at less than 1 PB can actually be a big red flag because investors see its future as being bleak. Remember that if a company goes bankrupt, you'll be covered if PB is less than 1. But that's not really what investors are worried about. Investors want to invest in companies that are going to outpace the growth. They're going to bring a lot of profits in. They're going to have great earnings. Price is always a forward-looking metric, right? You're building in future growth into the current price. If you take a look at Tesla's price, the current PE, PS, PB, it's nonsensical. It's so high. But people are willing to do that because of the rapid growth and potential that Tesla has. And they realize that stuff like PB, it's historical financial data. PE, PS, that's all trailing 12 months. It's historical financial data, and price is a forward-looking metric. Now, aside from the future being bleak, investors may not actually believe what the books are saying as far as the book value. They might be calling BS on it. So for instance, let's say a highly specialized company. We'll take NNDM for an example. They create electronics with really expensive 3D printing machines. They 3D print circuit boards. Now, some investors, they might look at these machines that are worth millions upon millions of dollars, and they might say, yeah, the machines cost that, but who's really going to buy that if the company goes and gets liquidated? Maybe these machines they believe aren't good enough. And so there's a lot of reasons that PB can be less than 1. And if PB is negative, that means that the company is insolvent, which means that the company has debt which exceeds the value of the assets. So if the company was to go bankrupt and had to liquidate, the stockholders would be in trouble because they wouldn't be getting much. And so as you can see, there's a lot of implications and there's a lot of many factors at play when looking at an investment, just looking at the fundamental analysis. You should never use simply PB alone. It should be used in conjunction with a lot of the other metrics that are available that I've covered in past videos and that I will continue covering in future videos. Okay, guys and gals, we're getting closer to the finish line. So let's take a glance at what market cap and enterprise value is all about, and then we'll take a look at some of the EV ratios. So in this video, I'm going to be answering the question of what is market cap and enterprise value, how they differ, and when to use each one. So both of these are measures of the value of a company, and it's used commonly in fundamental analysis. Market cap, very simply, it's the current price multiplied by the number of shares outstanding. And usually you won't even have to calculate market cap because any stock app that you use, if you Google a stock, if you Yahoo Finance a stock, you're going to see the market cap. It is a very readily available metric. And also, if you're curious on where to find number of shares outstanding, well, you can simply take the market cap divided by the stock price and you're going to get the number of shares outstanding. But it's not very accurate because the market cap, it does not take into account debt. And this is where enterprise value comes in. But even before that, I want to mention that a market cap, which is the current price multiplied by the number of shares outstanding, that current price, it's just dictated by demand and supply. It's where the buyer and the seller currently meet and say, you know what, this is a fair price. I'm willing to sell it and I'm willing to buy it at this price. But the price fluctuates, and so the market cap, it really fluctuates with it. And when we speak of market cap, this is when you hear of mid cap, large cap, small cap stocks, micro cap. This is all has to do with how large the market cap is. If the market cap exceeds 10 billion, we refer to it as a large cap. If the market cap is between 2 and 10 billion, it's a mid cap. And if the market cap is between 300 million and 2 billion, it is a small cap. Anything below 300 million, consider it a Reddit to the moon type of stock. So remember just a second ago I mentioned that market cap doesn't take debt into account? Well, enterprise value does. It is considered a more accurate measure of the real worth of a company. So it's basically the cost that you would have to pay if you wanted to buy the entire company. And it takes a glance at short and long-term debt, and it also takes cash into account as well. So in order to calculate enterprise value, you take the market cap, you add the short and long-term debt, and then you subtract the cash. So let's break that down. Why is that the total cost of a company? Well, because you would have to buy all the shares, that's the market cap. Then you would have to go and pay off the debt, the short and long-term debt. But then you would have to subtract cash and cash equivalents. When you talk about cash equivalents, that's just anything that could easily be turned into cash or liquidated into cash. And so the enterprise value, it's considered the theoretical takeover price. So again, I want to cover why is cash deducted from enterprise value? Because remember, enterprise value equals market cap plus debt minus cash. Well, think of it this way. If you're purchasing a house that costs $500,000, okay? But in that house, a safe that has $100,000 in cash comes along with the house. So you're paying $500,000 for a house that has a safe with $100,000 of cash in it. You're technically paying $400,000 because you're going to pay $500,000, but then immediately you're going to have $100,000 in cash. So technically you paid $400,000 for it. This is why cash is deducted from the enterprise value. And the same way, if the people who have the house, they owe a lot to the bank because they took loans out on the house or however you want to think of it, you have to pay off those debts. And so that's why debt is added to the market cap and cash is subtracted. Now remember, when looking at market cap or enterprise value, make sure to compare it to another stock in the same industry. You want to compare apples to apples when doing side-by-side stock comparisons rather than apples to pineapples. Now, I know that some of you are saying, Eddie, who the hell cares about enterprise value? But I'm telling you, once you start doing fundamental analysis, it is important because a lot of people use the enterprise value metric when they go ahead and they analyze stock because they use it in financial ratios. So they take that enterprise value and they divide it by certain things. It's similar to earnings per share. Why do we care about earnings per share aside from what earnings per share stands for? Because earnings per share is included in a lot of ratios that could tell us a lot about the big picture and the small picture of a company. And just like with any other fundamental metric, you don't want to just use market cap and enterprise value when evaluating if a certain stock is a good buy or worthy of more research into. You want to make sure that you're using as many metrics as you can to compare side by side, and that way you can have a more fruitful evaluation of a stock. Okay, so we've covered successfully all of these metrics. Now it's just time to cover enterprise value over revenue and enterprise value over EBITDA. And also, sometimes enterprise value, you'll hear people just say EV. Even though nowadays with the EV market, electric vehicles, people now say enterprise value, but a lot of times you'll hear EV over R or something like that for enterprise value over revenue. So what exactly does it tell us? Well, enterprise value over revenue, it looks at just the top line. So it looks at just the revenue, not the total costs associated with bringing in that revenue. And what it does is it compares a company's enterprise value to its revenue. And sometimes it's important to look at when there's potential takeovers or buyouts. People don't really focus on this too much, and there's not a lot in the literature, so I'm not going to spend a whole lot of time on it. But as you can see, Intel's right here is 2.69. And the thing about enterprise value over revenue or enterprise value over EBITDA, unlike PE, it can be used for non-profitable companies. Now, EV over EBITDA, and EBITDA, that stands for earnings before interest, taxes, depreciation, and amortization. So EV over EBITDA, it takes into account operating expenses. It looks at a company's ability to generate operating cash flows. And over here you can see Intel's is 5.82. Remember, if you like the Yahoo Finance platform, you can always go ahead, purchase a membership to it, then you'll unlock all these monthlies, annuals. I'm not including any affiliate links. I just want you guys to have an easy time doing fundamental analysis.
So thank you for watching this video in its entirety. I appreciate you for sticking around. If this type of content helped you out, help me out, leave a comment, subscribe to the channel, give it a like. I'm going to cover a lot more things that are similar to this. I'll include cryptos, options trading tutorials, my own personal investment journey. You'll see some tech tutorials once in a while, and it's a journey, and I want you to come along with me on it. So I'll see you guys in the next video.